Oh, well, yes, it's going to be the time of budget 2024, and capital expenditure is one important metric that all of us eye out for, given the kind of multiplier effect capital expenditure has on the economy. Now, the last few years, we have seen a solid push as far as Capex is concerned. In fact, if you look at the last 5 years, the Capex has pretty much doubled or actually tripled. It's doubled in the last 3 years, and the pace of growth has been also very strong as far as capital expenditure is concerned. In fact, over the 4 years, the increase in the capital expenditure has been to the tune of around 25% plus. However, having said that, this time around it's expected to come down a bit. I'll talk a bit more about that, but let me also put into perspective how much capital expenditure forms as a part of the overall GDP. Now, remember a decade ago, the average used to be around 1.8% thereabouts. That is the total GDP. Only 1.8% used to be spent on capital expenditure. That went up to around 2.5% a few years ago, but now we are closer to 3.4%, and that is where it is expected to peak, at least for the near term. But let me talk about what the expectations are from various brokerages about budget 2024. Jefferies believes that from that 25% plus kind of increase that we had seen in capital expenditure, it's expected to slip down to single digits. Perhaps 7 to 10% kind of growth is what we should pencil in. The stocks which are exposed to government capex might see a bit of correction because of this reduction in the pace of growth, but the potential slowdown in government capex will be offset by the continued push that we are seeing in the real estate sector plus the entire private sector, and that's the reason we are expecting there could be a bit of a move in some of these other stocks. Particularly in roads and rails, they are expecting there will be a 5 to 10% increase in the overall expenditure, as well as the power sector, public sector entities might stand to gain. Let's take a look what Goldman Sachs is also saying. They believe that the capex as a percentage of GDP will be peaked at around 3.4%. The growth rate they are saying is expected to decline to 6%. So this is even lower than what Jefferies is saying, and they are expecting welfare spending to get a boost. Motilal Oswal also believes that there is going to be a bit of push when it comes to the populist measures, given this budget is going to be ahead of elections. They're also talking about how the overall capital spending, of the government can take an inch up by around 15%, so at least they're in the double-digit mark. Defense, railways, roads and highways is something that they believe will get the bulk of the capital expenditure. Equiris believes that the YOY growth in the entire capital expenditure could be 17%. So the range is really wide here, right from a 6% to 17%. But they are saying sectors other than railways and roadways should also come on the anvil of the government, because last few years it's all about being this sector, and capex is lagging in the non-transport sectors. Capex to GDP, they believe, will be around that 3.3% mark. So there is a consensus when it comes to the capex as a percentage of GDP. They're expecting it to be 3.3 to 3.4. But the question is, how do they walk the tightrope between fiscal prudence, fiscal deficit targets, as well as capital expenditure? And of course, with election being on the top, what do they do with respect to the populist measure is something to watch out for, guys.
We've got Amit